The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning, everyone. Welcome to Squawk Box Europe. I'm Sylvia Mairo. It is 8 a.m. here in London, 9 a.m. CET, and stock markets across Europe are opening for trade on what is the first trading day of 2026. We're still waiting to get a little bit more clarity in terms of what sort of direction we might get in European markets later today. But it is worth keeping in mind that we are still dealing with thinner volumes. After all, it has been a festive season. A couple of bourses are just returning for trade as well after being closed on New Year's Eve. And worth keeping in mind as well that there's a couple of important market themes as we begin a new year. We have, of course, the overall story around where we go in terms of AI spending, the outlook for Fed policy with a new chair is expected to be announced at some point this month, in fact. And on top of that, when it comes to Europe, a lot of question marks as well about where we're going to go in terms of fiscal spending. Will European governments deliver on the promises that they made in 2025? But let's dig deeper and get a check on what's happening across the several sectors so far in early deals. At this stage, we have basic resources at the top, so we continue to see further momentum for this part of the market. A lot of movements here are coming from the fact that we continue to see a rally when it comes to some of the metals, in particular when it comes to gold, silver, and copper. So let's see what will happen in the space later as well. But in terms of metal prices is also a key indicator for us as we begin a new year. But let me take you to the worst performing sectors too, so we get a full picture at this hour. We have household goods actually under a little pressure, lower by about 0.4%. Construction and materials also trading lower at this hour. But let me take you to the different bourses too and get a check on the various bourses across the European continent. In terms of some of the moves here, it seems to be a little bit of a mixed picture. We have just a little bit of pressure for the CAC hunt over in France. It's worth keeping in mind the context here, however, because 2025 was a very strong year for European bourses. And here I just would like to remind our viewers that in terms of European equity performance, 2025 was a stellar year in particular for the Italian market. It saw its best year since 1998 last year. So let's see what 26 will have for all of these European markets. But in the meantime, let's discuss the outlook with our next guest. We have Tom Hibbert, Chief Investment Strategist at Canaccord Wealth. Tom, great to have you and Happy New Year to you.
Happy New Year.
Look, 25 was a very important year for European equity performance. As we begin a new year, I'd just like to start the conversation by getting your thoughts on where do you think Europe is going to go?
Yeah, it's been so interesting that peripheral Europe has been really strong while core Europe has been quite weak. And if you look back to 2024, as the ECB was easing policy, the expectation was that more services-based economies would, which had outperformed it in 2024, the more manufacturing-based economies, core Europe, France and Germany, would do better last year. And we didn't really see that happen. We saw peripheral Europe continue to outperform, which was a bit of a surprise. I think looking ahead to next year, we could see, with infrastructure spending in Germany, we could start to see core Europe doing a little bit better. And I hope to see a bit of a recovery there. But it is interesting that we still see peripheral Europe really outperforming core Europe to the extent that we have in 2025.
So does that make the Eurozone a little bit more homogeneous when it comes to investment opportunities?
Not particularly. I think there's a vast array of different.
What would you highlight?
I don't have a particular highlight. Sorry.
That's okay. I was just wondering because obviously for our audience out there, they are wondering, do I look at German equities? Do I look perhaps at fixed income in Italy? There are several options in the markets ultimately, but perhaps more broadly, when you think about the key market narratives for Europe this year, you've highlighted in the past, a change in monetary policy. Mm-hmm. At this stage, we know the fiscal policy will be very important. But what are you expecting from a monetary policy perspective?
So it's the ECB. I mean, they're in an interesting position at the moment where they're basically at the perceived neutral 2%. So the expectation is for them to sort of remain there for the time being. There is an increased probability that with the fiscal stimulus that we have coming in Germany, that we might see a little uptick in inflation expectations towards the end of the year, and maybe we'll see the ECB have to start looking at raising rates again towards the end of this year or 2027. But at the moment, they've got nothing to do. They can kind of sit in their hands. They have a bit of dry powder for the first half of 2026.
Which is an interesting position to be, because that hasn't happened for a very long time. So let's see indeed what they will decide later in the year. In the meantime, I would like to focus on the UK for a moment as well. What are you expecting for the UK economy? This government has promised growth. Do you think we will see it? And what will that mean also in terms of some of the positioning for UK assets?
Yeah, it's really interesting. After the budget, we obviously saw quite a significant fiscal tightening. It could have been a lot worse. Could have been better. Could have been a lot worse. Our anticipation now is that the UK economy, continues to, I think, slow. For gilts, I think gilt valuations look quite attractive. So we see some upside from UK gilts this year. Valuations look attractive. We see really strong disinflation momentum at the moment. Expect inflation to fall quite sharply in the second quarter of this year. So that should provide a good tailwind for gilts. I think the tax situation and the tax burden in the UK is a bit of a challenge. And if you speak to Arthur Laffer, the UK seems to be on the wrong side of the Laffer curve at the moment. So I think that will be a bit of an issue. And I don't think the budget really addressed enough the long-term productivity issues, despite providing some short-term fiscal headroom, which provides a tailwind for gilts. The long-term sort of productivity questions still remain in the UK.
But if we see lower inflation, if we see the Bank of England also lowering rates, could that actually bring a little bit of a positive surprise for the Labour government, and will allow them to do more also on the growth front?
Yeah, potentially. I mean, if you look at equity markets, for example, domestic equities are trading at quite attractive valuations. I think it's very easy to paint a pretty negative picture on the UK economy. But a lot of that is priced in. So a great contrarian trade, UK small and mid-cap equities, I think where there is a lot of negativity, it doesn't take a huge amount for there to be a positive surprise. So that's a market that I think looks quite interesting.
Now, it's also important to keep in mind the overall market narratives here, because there could be spillover effects into UK assets too. So when you think about, for instance, the hype around AI spending, to what extent do you think that is going to be important for European and UK markets in 2026? Or do you think this is perhaps more contained in the United States?
I definitely would say that's more contained in the United States. I think Europe is a bit of a laggard within that space. So it's much more of a US story. And I think that's an issue actually for Europe to face, where the tech sector just isn't as exciting and can't compete with the developments that we're seeing in the US.
But from a market perspective, there have been second round effects, if you want to call it like that. For instance, one of the sectors that performed better last year was actually utilities. Investors thinking, okay, we're going to need more energy to power all of these data centers. So is perhaps the AI story from a European perspective going to play out like that in a kind of a second round effect?
I think that's certainly true. Utilities, and also you see beneficiaries in commodities markets as well. Yeah. We're seeing copper is a good example of that, where there are clear supply shortages, but the demand picture is very, very solid. And also you see just this electrification theme. I think copper could do really well in 2026. Is very well set up for that sort of trade, and a lot of that will be on the back of electrification and AI capex.
Speaking of metals, 2025, what a year it was for some of these metal prices. Perhaps we'll just recap a couple of the numbers here for our audience, because it is astonishing when you look at the year-to-date performance. Copper saw its best yearly performance since 2009. Silver and gold both saw their best year since 1979. So the performance is astonishing ultimately. Do you think 26 could bring similar levels of performance, or do you think that even if we see a rally in this space, we'll be a little bit more limited?
No, I think we'll see similar performance. I mean, given the recent strength of gold and silver in particular, I think there's a tactical opportunity in copper, as I've just laid out. But the fundamental picture for gold and silver is still very strong. So For example, the fiscal trajectories of major countries, I think people are looking for alternative stores of value, and gold and silver just are really fitting the bill for that at the moment. So there's a huge amount of demand there. We've obviously seen the leverage requirements change recently, which has injected a little volatility, but overall I'm pretty positive on the outlook for gold and silver, given the uncertain fiscal outlook for major economies.
And you have the geopolitics also playing a role here, right? Well, Tom, stay with us. We'll continue the conversation in just a moment. Tom Hibbert here, Chief Investment Strategist at Canaccord Wealth. But in the meantime, a couple of corporate stories that we're following today. Ørsted has filed a lawsuit challenging the Trump administration's move to suspend the lease of its wind farm project off Rhode Island. The Danish energy firm, says the government order to halt the lease violates applicable law, adding that the project was due to start generating power as soon as this month. Now, shares in the company lost nearly 35% last year, and we know the tensions here with the Trump administration have been a key factor influencing here some of the share price moves for Ørsted as well. Now, elsewhere, the UK house prices unexpectedly fell in December, ending the year 0.6% lower than in 2024. This is according to data from Nationwide, which shows the weakest growth since April 2024. Prices fell by 0.4% on the month. And coming up on the show, a new chair, further questions over its independence, and an AI boom are all in the Fed's intro for 2026. We'll discuss right after this break. Stay with us.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Welcome back to Squawk Box Europe. Now, it has been 30 years since the former Fed chairman Alan Greenspan made the decision to hold rates as technology investment drove a productivity surge. Today's Fed faces a similar issue with questions of whether current AI investment will also drive a productivity boom. Our very own Steve Leisman filed this report.
2026 will mark 3 decades since Fed Chair Alan Greenspan made one of the most important and toughest calls of his 17-year career. His colleagues wanted to raise rates, but he decided all of the investment in technology back in 1996 meant he could run the economy hot with higher growth and little fear of inflation. Among his colleagues, Janet Yellen, who would go on to become the chair of the Federal Reserve, and Alan Blinder, who urged Greenspan to hike rates. But Greenspan, he was right. Inflation plunged, and he held the line on rates for 3 years. Fast forward 30 years, and the current Fed chair and the next one face a similar call. Will the AI investment surge create a productivity boom that means lower rates for longer and stronger growth without inflation? New York Fed President John Williams said last week it's already informing his view of monetary policy.
What we've been seeing, which is actually very good productivity growth over the past few years, around 2% or so. So that's already happening, and I think that's going to continue for some time. I don't have a crystal ball that tells me what productivity will be, but if the AI boom does turn into a sustained period of productivity growth in the U.S., then I think those are the kind of developments we would expect.
There are risks. The administration's immigration policy means the labor force may be closer to full employment and potentially closer to generating inflation in a hot economy. Tariffs and higher inflation already raise the risk that growth could run too hot. And most important, as former Fed Vice Chair Rich Clarida points out, Greenspan eventually had to ratchet rates up. He said in a recent blog, productivity growth raises supply and thus tends to lower inflation pressure. It also encourages demand through higher investment and the wealth effect from booming stock markets on consumption. And that is ultimately the Fed's job. Don't stop the punch from being served, but take away the punch bowl before things get out of hand. Steve Leisman, CNBC Business News.
And of course, we've also been asking our guests for their outlook for the Federal Reserve this year. So take a listen.
He's emasculated Powell by saying, I'm naming the new person in January. That means, look, Powell's gone in May. He's not going to stay around to 2028. So Trump gets to pick a new chair and then another position, and suddenly the balance of power on the FOMC is quite tilted, and it is going to be more dovish. And I think they'll look at the data and find a reason to be more dovish.
One person cannot change globally the direction of monetary policy in the US. It's a very consensual way of doing this, of delivering decisions. That has been the case for the past 20, 30 years globally. We don't see a significant change, but we see an increased sensitivity to the second pillar of the Fed, meaning a greater attention to economic growth and the job market.
There's going to be a battle for central bank managers. Who's going to actually manage central banks? Is it going to be the politicians or the central banks themselves? In other words, central bank independence, which I suspect the Fed will lose. And I think that'll undermine financial markets and undermine the dollar.
And Tom Hibbert, Chief Investment Strategist at Canaccord Wealth, is still with us. Tom, no doubt this is one of the key topics for markets in 2026. What do you think will be more important as you assess the outlook for the Fed?
Yeah, the Fed is changing across multiple dimensions, right? Because they're moving from a restrictive stance at the same time as that's one dimension of change. The other is obviously the change of Powell's term coming to an end. Kevin Hassett has emerged as the clear favourite. I think the argument, although he might be aligned with the administration, there are some concerns there. I think the arguments that the Fed is losing its independence or might lose its independence is a bit overstated, and the FOMC is still a committee at the end of the day. I'm actually more positive than the broader market on Fed independence. Well, I think the Fed has, in many ways, overreached with their liquidity policy in recent years. And at the same time as the Fed's concluded quantitative tightening and they're now moving to this new balance sheet maintenance regime, I think under any new chair, there is an opportunity to use liquidity policy not just to steer the economy, but to stabilize short-term funding requirements. So the last 15 years, we've seen, what Scott Bessent and the administration talks about as gain-of-function monetary policy, where they've overused liquidity policy a little bit, and that has undermined the financial system and jeopardized the Fed's independence.
But what they would have argued in that case is that they had to do it. Right, that the economy was in a state that they had to have perhaps a more hands-on approach here. So as you think about 26, what is the likelihood of a more dovish Fed from the data perspective, given that you don't think that necessarily that would come from, let's say, political interference?
If you look at the minutes, I mean, one of the that were released last week, the undercurrents from that were actually relatively hawkish. So, although the Fed does want to ease policy, and we've had 175 basis points of cuts so far, I think they're going to struggle to carry through another interest rate cut from here, and are more likely to be on hold. So that's my sort of expectation.
But on hold until when?
On hold until they say they're data dependent. So if we see a deterioration, there's clear negative momentum in the labour market at the moment. If we see more of a deterioration there, then we're likely to see them become more accommodative. Generally, I still expect the Fed to become more accommodative slowly, more gradually, but there is now this more data dependency that they're on. And obviously, there are risks on both sides of their mandate. There are upside risks to unemployment. There are upside risks to inflation. So it's a complex position that the Federal Reserve is in at the moment.
But that's exactly where I was going to go next. And the fact that they have this dual mandate, there's a school of thought suggesting that they will be paying more attention to the labor market in 2026. How are you looking at this balance between inflation and labor markets?
Yes, so I think they will be. They seem to be prioritizing the labor market more than they have been. I think the risk is that if they front load more rate cuts and if they overexpand liquidity policy again, that we start to see inflation risks pick up towards the end of this year, early next year. So I think that's the key risk for the Fed at the moment. It does seem that they're prioritizing the labor market for the time being. And I think it makes sense given the lagged effect of interest rates for them to be moving more accommodative, but given the 175 basis points of cuts that we've already had, I think it's going to be more difficult, and how finely balanced the debate is on the FOMC, it's going to be more difficult for them to cut rates aggressively again from here.
Now, there's one aspect that perhaps we haven't focused on yet, and that is how fiscal policy might have a role also in the outlook here. Because, we're going to have the midterms. There's question marks about potential government shutdown as well in 2026. How are you looking at fiscal policy also in terms of the outlook for where the Fed might go?
Yes, so we're seeing a huge amount of fiscal stimulus that's coming through this year, and a lot of the macro that provides a lot of macro tailwinds for growth. And our expectation is for the U.S. economy to continue to grow strongly. The problem that the Fed faces is that yes, they want to ease policy to take the stress of the pockets of weakness. People talk about this K-shaped economy, so they want to take the pressure off the labour market. They want to take the pressure off the housing market. But they are fundamentally easing into a position of aggregate strength, partially driven by this sort of fiscal spend and fiscal stimulus that we're seeing. So it makes the Fed's position complex because they want to ease policy in one respect to take the pressure off the labour market, but the inflation risks are still present, which makes it a challenge.
That brings me to the other key theme, which is AI spending, right? It's so important when it comes to the outlook for the US economy. We saw how important that was in 2025. Do you see any risks for markets in 26 as a result of what some would say that there's a bubble in terms of AI?
I do. So market valuations are pricing in a lot. There's a lot of optimism. And we still see very strong corporate earnings coming through, and I expect that to continue to be the case. We've had 4 quarters of double-digit earnings growth, and that supported markets in 2025. I think for current valuations to be justified, 3 conditions really need to be met. The economic environment needs to remain benign. That will then help see these corporate earnings come through, and earnings expectations need to be met. So that's the second, corporate earnings expectations need to be met. And finally, the productivity enhancements that have been promised by AI, and through the vast capex that we're seeing, we need to see some clear benefits of that and efficiencies coming through there. So there's a lot, although I'm optimistic on the outlook for markets, there's also a lot priced in, which creates a bit of vulnerability.
Well, let's see what will happen. No doubt AI will also be an important one to monitor. Tom, great to see you. Thank you for joining us on this first trading day of 2026. Tom Hibbert there, Chief Investment Strategist at Canaccord Wealth. Now, elsewhere, President Trump's tariffs targeted a range of countries and sectors, with the film industry being no exception. Ritika Gupta took a closer look at the potential fallout.
If they're not willing to make a movie inside the United States, and we should have a tariff on movies that come in.
US President Donald Trump has renewed his threat to impose a 100% tariff on all films produced outside the US, a move that could upend the international film industry and hit Britain especially hard.
Here at the BFI London Film Festival, Black is Beautiful, a UK-US co-production, is celebrating bold storytelling and cross-Atlantic collaboration. But the red carpet glamour comes amid a backdrop of concern. President Donald Trump's threat of tariffs makes projects like this far more expensive and far harder to get off the ground.
It has the potential to be catastrophic, but I'm also quite hopeful that it's not something that will be enacted, because it would also really badly damage the American film industry as well.
I don't know if that's going to come to pass, but yeah, it's definitely, it wouldn't be a good thing for the industry. But I think, as creatives, all we can do is continue to make the work and sort of try and tell these stories, which is the main thing.
Caroline Dinenage, MP and chair of the UK's Culture, Media and Sports Committee, says it's important not to underestimate how vital creative industries are for the UK economy.
We know that it's worth about £126 billion a year, our creative industries. Quite often people think about film and television as being things that make you feel good, things that entertain you, but actually they create thousands and thousands of jobs and huge amounts of inward investment. The British film industry already suffered a bit because of the impact of the pandemic, but we only really understood the extent of the particularly US investment a couple of summers ago when the SAG-AFTRA strikes happened, and we saw a lot of the productions that were happening here in the UK dry up. And if, as a result of these tariffs, that was to stop coming over here, that would make a big impact. It's a really important thing for our Prime Minister to be discussing with the US government, and I think it should definitely be front and centre of any future trade discussions.
The UK film industry is dependent on a good relationship with the US, but the proposed 100% film tariff could cause cracks to the relationship.
We are quite reliant on the US investing into the UK to make films. We kind of have to wait for them to say, we're going to make a film, and then we scramble around to make it happen. We're not so great at having a pot of money for the UK to say, we're going to make UK films. And so if that money doesn't happen anymore, we're kind of stuck. We don't have that huge amount of investment to make our own films.
View Cinema CEO Tim Richards says this makes it difficult to enforce tariffs.
How do you define what is going to be actually hit by these tariffs? And that's what everyone's really been focusing on. I think because of the complexities, because there are other ways of actually implementing and getting to the same place through tax credits, even what Gavin Newsom has been proposing as well in California, that there are other means of achieving the same goals without having the impact on the industry.
Ritika Gupta, CNBC, BFI London Film Festival.
And coming up on the show, 2025 was a busy year in European politics. We'll be taking a closer look at some of the key moments, and we'll be discussing as well what to expect in this new year. So stay with us. We'll be right back.